Hey there, it's Mitch Goldberg. You are now just tuning in to Be the Boss of Your Money. This is a show, a live stream podcast, highly educational. It's all about personal finance and going through the most important business stories of the day, breaking them down and sharing with you exactly what you need to know, what's relevant, and what could change for you. It's also about investing. It's a little bit about trading, but mostly personal finance and to help you become the boss of your money. So we're going to roll the intro today. Huge rebound on Wall Street. Just a massive rebound. I think caught a lot of people by surprise. And that is what we're going to get into today. So we'll roll the intro and then we're going to get into this. Here we go. Hey there, are you an investor? Are you saving for retirement? Maybe putting your kids through college? Maybe you're just getting started. Maybe you're getting started a little bit late and you want to catch up. You know what? This show is for all levels, but I'm going to teach you something here every day. I have over 30 years of experience as a financial advisor dealing directly with clients, just like you, with retail clients. So I've learned a lot. I spill my guts every day. I tell you everything I know, all the secrets. If you're just joining me now, welcome. If you have any questions, please hit me up in the comments. If you're watching in the live stream, welcome to you as well. The comments, hit me up there. I will see your questions. I'd love to answer your questions. I see Eddie is out there. Eddie, thank you very much for joining me. It's pretty cool. And really cool to have a professional live streamer watching me now. So I hope to get a detailed report for you, you know, like what you did wrong, what you did right, what you could do better, and, you know, all those things. And, you know, don't hate me. I'm not using my Blue Yeti microphone anymore. I'm using my Shure MV7, but the Blue Yeti was a great mic. Don't get me wrong. Okay. What a day in the market. The market caught so many people by surprise. We were getting pummeled. Stocks were going down. The high flyers were getting crushed. The work from home, stay at home category, all those stocks that benefited from the lockdown were just getting smashed for about 2.5 weeks straight. Interest rates were going up, which lowers the value of future earnings, which means high flyers, high PEs, where stocks not just trading multiples of earnings, but multiples of sales. Those are the stocks that typically get hit the most. Interest rates are rising, but everything was suspended. So let's have a round of applause for the market. Yeah, market. All right. So we are just excited about that. I don't get overly excited about down days or up days. The fact of the matter is, today is a perfect example of why I always say I don't like all in or all out strategies. They don't work. You know, today I'm going to be all in work from home stocks. I just want FANG stocks. I just want Zoom. I just want DocuSign. And the next week you're like, I just want Dow Chemical and Southwest Airlines and maybe, you know, Honeywell and John Deere and Caterpillar. People are just trading themselves into oblivion. What I've said here from day one on this show, especially when the pandemic started, the stock market was going up and people were like, how could the stock market go up so much if the economy was so bad? Because the work from home, stay at home stocks that were favored the most, like Amazon, Facebook, Amazon, Netflix, Google, Microsoft, they actually benefited from the lockdown. And since they're the biggest stocks in the S&P 500, they have the biggest impact on the S&P 500. That's why the market went up so much. Okay. The S&P 500 is an index. You can't invest directly into an index, but you could invest in a stock or in a security that tracks or mimics the S&P 500 index. Okay. So we had a huge rally today, but it wasn't just industrials. It wasn't just work from home. It was both. We had a deeply all-inclusive rally today. All 11 sectors All 11 sectors of the S&P 500 were up. I think there were maybe out of 500 stocks in the S&P 500, I think I just checked, 38 were down and the rest were up. But the up volume to down volume on the New York Stock Exchange, the big board, was a ratio of 4-1. That's extraordinary. What happens also, if you're a chartist, the rally today it takes away a lot of the negatively forming charts, the negative technical analysis point of view from last week, and moves things back into a bullish position. So what happened last week and the week before, interest rates really skyrocketed. And today they kind of just went down a little and then came back up a little, off a drop for the day, but they just stabilized. You know what we have right now? I'm going to give you a word. Goldilocks. Not too hot, not too cold, just right. That's the environment for the economy that we have now. At least it looks like that. And it favors stocks of all kinds. So it's not just a hot economy with inflation and rising interest rates that hurts work from home, stay-at-home stocks and compresses PE ratios. And it's not just a bad news is good news economy where that would benefit the work from home, stay-at-home, technology-oriented stocks. We've got the best of both worlds, baby. It's Goldilocks. So that's what this is all about today. And for the size of the rally, let's put it this way. The NASDAQ was down 4.9% last week. It was up about 3% today. But the Dow and the S&P made up for last week's losses with today's rally. All stocks, all kinds of stocks went up today. If you sold your stocks last week deciding it's time to get out, panic mode, if that's what you did last week and you're buying them back today, well, my friend, you're doing something wrong. We don't want to do that. Ask me questions in the comments, okay? I'd love to interact with you. That's the best part of the show. That is why it's so important to stay the course and be diversified. I always ask, what good is a portfolio if you can't stick with it? And if you're in too heavy in just tech or too heavy in just industrials and one or the other doesn't work out, people have a tendency to get a little scared. They want to reduce their positions or just sell it all together, and then they miss the rallies. Listen, Warren Buffett has said, if you think the stock market's expensive today, wait until you see how expensive it'll be in 20 years. I agree with that. What we are all about is education. And if you have a financial education, you trust the process. You invest, you diversify, dollar cost average if you can, or put it all in. There's benefits to both. The fact is most people don't have a massive lump sum payment to put into the market when they're getting started. That's why they invest in a 401k plan, for example, every pay period. And some people do have a lump sum, maybe when you have a big 401k rollover or something. Either way, the rules still apply. Diversification is not about maximizing gains. It's a strategy that's used to minimize risk so that the worst performing investment in your portfolio doesn't crowd out the performance of all of the other investments. Okay. It doesn't necessarily prevent your portfolio from going down in a generally down market, which we sure discovered again last week, but it can help you go down less. It could help you recover quicker. Today was an example of that because remember, it's great to go for the gusto and have all hot stocks. That's great. You're riding momentum. And when that turns around, it's brutally painful. Everyone today, I think, got a little lucky. So what did you learn from last week? Here is what you should learn from last week and what you should definitely take away. Hold on. We have somebody out there. Ron, hey, man, great to see you. We can't underestimate how much greed clouds judgment. So true. Greed and fear are the two key emotions when it comes to investing. By the way, Ron, we also have Eddie Garrison, who's out there watching. So you both, the three of us, we're in the same, Facebook groups on StreamYard and ATEM Mini, right? that's pretty cool that you guys both are out there at the same time. Thank you. By the way, Ron, thank you for the snippets and for the material, the digital stuff that you sent to me. That was amazingly kind of you. I'm going to reply to you through DM and Facebook. Okay, so here's what we're going to do. We're going to go through a quick wrap up. What happened today? I have to show you the stats. And then we're going to go into why did the rally happen today? Is the interest rate worry already? And what about the stimulus, which is coming out very, very soon? Whoa, the stimulus is huge. That is just, it's huge. You've got to see that. So let's get into it. We're going to do some share screen, give you a view of what things look like from the top. Hello, everybody. And let's get into a share screen. Put myself up here. Hello, I'm over here in the corner. You see me? Okay, so the Dow is up over 600 points. It was up over 700 at one point today, but let's not complain. Let's not get spoiled about that. Up almost 2%. NASDAQ up 3%. S&P up about 2.4%. Gold off a little bit. Oil off a little bit, but oil has been having a very sharp rally. So we could forgive oil for going down a little bit. The 10-year, like I said, backed off just a drop. The dollar kind of slightly weaker, but the VIX down to 23. The VIX was down 4.6. The VIX was down 16%, negative 16%. I don't know if you can see that on your little screen there. That was pretty big. Look, this whole time I've been talking about hopefully a VIX going below 20. We see that could actually give the stock market a whole leg higher. There's a lot of ifs here, a lot of coulds, okay? Steady Eddie is the man. Is that what we call Eddie? Steady Eddie, is that what we call you? Steady Eddie. I'll take it. That's cool. As long as you're not offended, okay? So we'll go with that. Let's keep going. Top gainers. Let's take a look at the Dow. Boeing was up almost 6%. Apple up over 5%. Dow Chemical. Has anybody noticed Dow Chemical, like a total sleeper stock at 30 is now 61? Goldman Sachs moving up. Intel moving up. Intel's been moving up pretty solidly. Travelers 150. Disney back to the 190s. Okay, so you see the only two stocks in the Dow that were down, Merck and Walgreens. Merck has been like just in a bad place for a couple of months now. That was finally broke 80, 82, like 84. Just like sells off a couple of pennies like every day. All right, that's Merck. But Johnson & Johnson was up because, well, they were up because the market was up, but they also were up because of the vaccine. And let's just take a look why. I want to show you this. This is key. This is so important. I hope you guys are sticking around for this, okay? This is giving you nuggets. The reason I think that the interest rate rally, the big move up in yields stopped is because of what you're looking at right here. If you see this, the 10-year is 1.42%, but the Bund, that's the German equivalent, that's the 10-year German benchmark bond, their version of a treasury, their sovereign 10-year, that is only 0.33%. The Japanese 10-year is only 0.15%, and the UK is only about 0.75%, and France is 0.1%. I think what happened is you have global investors who saw the 10-year at 1.5%, and they compare that to the yields in their own country, and they were all over that. They were like, we have to get that. And I think that is what pulled yields down. Believe it or not, on a global sovereign quality level, the 10-year yield at 1.5% is very attractive to foreign buyers. And I think that is why the yield rise stopped for now. It could change. We could get inflation. It could change. We'll see. Well, we have inflation coming, in my opinion, and the economic statistics have been coming out strong. But Jerome Powell, who's chairman of the Federal Reserve, seems to disagree with everybody. So who's right, the market or Powell? And does Powell have the might to make right? Okay, take a look. Bitcoin had a nice rally up almost 10%. Ethereum up almost 10%. XRP, Litecoin, Bitcoin Cash. So nice rally in the crypto land. And this is the most important thing that I look at every day. These are the sectors. These are the sectors of the market. Okay. We have, just want to see who else is out there. We have, or Daddy G, if you prefer. That is too funny, Ron. XLK up 3%. So technology leading the way. These are the major ETFs that track the 11 sectors of the economy. Okay. So tech was up 3%. Financials, energy, industrials. I always say financials, energy, and industrials, the key economically sensitive sectors. You want financials to lead the way. At least you want financials to do very well. I have to stop shaking the table. I see the camera doing this. You want financials to lead the way. And I put out a video recently, one of my lives, maybe a month ago. I said financials could do very well because of the yield curve. The difference between short-term rates and long-term rates, the bigger that spread, the more money banks make on their deposits. And in the United States, there's trillions and trillions of dollars on deposit at the banks. And if banks could make money on that after cutting costs for years and years, that is a huge boon to earnings. Could be a huge boon to earnings, I should say. I'm very optimistic that it will be a boon to earnings because I know how the yield works. I understand how this stuff is supposed to work. Okay. I've been doing this a long time. So let's cut the share screen. Let's get back over here. Okay. So what else do we have to cover? Stimulus, $1.9 trillion. I'm calling it ARPA. It stands for American Rescue Plan Act of 2021. And if we go big and bold, hopefully that means we don't need an ARPA of 2022. So we're going big, we're going bold with this. $1,400 checks could literally start going out. I think Biden wants to sign this into law through reconciliation through Congress by the 14th. That's a Sunday, because that's when extended federal unemployment benefits in the United States run out. So he wants it to at least go to that point. After that, a week later, the 21st, so let's call it the 22nd, people could start seeing the money hitting their checking accounts, direct deposit. And this is a credit. So even if you made no income, you'll still get the credit. It's for people who make $75,000 and under. If you make $75,000 to $100,000, it phases out. So by the time you hit $99,999, you're basically getting nothing. At $75,000, you're getting the full amount. At $75,001, you start to lose a little bit. $150,000 to $200,000 is the range for couples. $125,000 to $150,000 for head of household. Okay. This market shows you why I don't like the all or nothing trade. All right. That is why. What else? Let's interpret a few other things. We're almost done already. GM came out about 3 weeks ago and said, we're not going to hit our numbers. And everybody's getting bulled up. GM was going up. Then it goes down because it's going to cost them a couple of $2 billion in lost revenue. That's a big deal because GM has been in some form of restructuring literally since I got into the industry in 1990. And they're finally past it. So a few extra $1 billion added to their revenues is a big operating leverage score for them. So if they can't sell cars, they can't make cars because there weren't enough semiconductor chips. You know, there's like hundreds of semiconductor chips that go into cars. Last week, GM said, yeah, you know what? Scrap that. We will be able to source enough chips and we'll make our numbers. We'll make up for any lack of numbers in the first half. We'll make up for it in the second half of 2021. So don't worry about that. It's over. So now it's really hard to find something wrong with this rally. Interest rates were the big thing, but if interest rate rise is arrested or at least slowed down, then that's very optimistic for stocks. It's not so much that interest rates go up. It's the speed at which interest rates go up. That is a much bigger concern than the actual interest rate rise. So stimulus, we've got a lot of things going on right now. Okay, that was so sophisticated. We got a lot of things going on right now. But those are the reasons why. I thank you for watching. We will be back, meaning I will be back tomorrow. I greatly appreciate you spending some time with me. It means a lot to me. Your time is precious and so valuable. So we will get back to you tomorrow. Thank you and have a very good rest of your day.